implied volatility. Opex flows. Vanna. It's pretty confusing, isn't it? Does it make you feel bored or confused? Well, that's the intention. Wall Street likes to use complicated terms to make you believe only they can handle it. Or even better, just to leave them alone. So here's Margot Robbie in a bubble bath to explain.
Basically, the CBOE's zero DTE options are amazingly profitable for the market makers. They make billions and billions on the spreads they receive for running their quotes. But then they have to deal with the risk of holding them. After all, there are so many option sellers and only so many Muppets with deep enough pockets to buy them, right? So dealers started hedging these books with faster and tighter systems. Thank you, Banjo. That way they can keep that profit machine churning, right? By the way, these hedging programs are all real-time. So whenever you hear real-time, think edge. Our friend VolSignals discovered these index markets, which were supposedly hard to trade, were actually quite easy to predict. So now he's giving you back your edge, which means to help you win. Got it? Okay. Now fuck off.
Matt, good morning. I'll add you in a sec. All right, morning, guys. So today we're going to talk about Opex, obviously. Can you guys hear us on the YouTube? If anybody is watching, please just go ahead and chat something in the comments so we know. Hope this works. Cool. Yep, thank you. So we had one of the largest modeled selling flows that we've had in all of our data. I think it was very interesting. Overshot all of what I expected to be reasonable targets in full disclosure, but it correlated really well with the actual charm map, which I'll show you guys in a second. As I say all the time, Opex seems to be bigger than even the inventory implies. You could speculate as to why that might be, but it just seems to be the case more often than not that when we get these big expiring positions, they show up stronger than they would otherwise if they were just like a traditional zero DTE. Now, maybe I think there's good reason that that could be the case. Obviously, like settling a position in the overnight is going to imply less liquidity for the hedging out of the book, so that makes sense to me. Also, these are benchmarked to other things as well that are not as visible. And so I think there's probably additional hedging that we can't necessarily model, we can only infer. Matt, you here, buddy? See, can I hear you?
Call me up, yeah.
There we go.
There we
Okay.
go.
All right. So I don't know who's new here, who's not. Obviously, what we're going to show you is the data from VS3D. So Matt and I have both been market makers. Matt for about twice as long at a lot of different banks. And I was always at a traditional prop market making firm with an index focus. And so this is very native to us, very used to it, but expiration cycles are always interesting. Now we model the data with VS3D. So we don't have, we're not at market making desks right now, but we have the same data in some ways better than a lot of our colleagues have because this is market wide. This is not just firm wide. The platform has a trial for the time being. If you haven't tried it yet, I encourage you guys to, while we still do make them available. For 7 days, you just go to vs3d.volsignals.com. You can see all of the stuff that I lean on to really do all my content, to inform my market view, etc. It's real dealer positioning. It's not GEX. So I feel like we should create a new word for this because GEX is misused all the time. This is accurate dealer positioning with more Greeks than just gamma. And also we spend a lot of time on education and making sure that people understand what they're looking at. Matt, you want to chat really quick about the expiring position while I set the other stuff up?
Yeah, let's take a look at it. This is what's expiring today.
Yeah, this is the AM. Well, you know what? Let me make sure I'm looking at the right thing here. So I'm going to get rid of these previous comparison dots. Should be the right thing. So our platform, if you're in the trial yourself, you should see that the position defaults to the nearest upcoming position. So at 9:30 Eastern on the dot, this will just rotate through to show you the PM expiring position. Because obviously you don't want to think about AM expiring position at 9:35 because it's already done. All the flow has already happened.
Correct.
So here is August AM.
Let me talk a little bit about it.
Okay, there we go. We just cleared a hurdle, it looks like, or clearing a hurdle.
Yeah, so interesting. Yeah, it looks like we cleared the 75 hurdle, right? Heading up. I mean, to me, it looks like we're gonna find balance somewhere between 80 and 90, somewhere or 80 and 95, as long as we clear that 75 hurdle. That's what it looks like. That's what it looks like to me.
Yeah, we might get some late session charm depending on how much, these AM expirations aren't as clear because you don't have like good market derived Greeks. Obviously, we would usually have like live straddle values, but because it's AM, you don't really get the same on a serial. But yeah, it all depends. If we have any kind of charm up through 76, 75, it could be a little bit more, right? Because there's a considerable amount of minis implied to be buying here. I wouldn't think of there to be any real charm coming from these positions up here, even if we run to them, because that would first depend on market makers to gamma hedge them, right? So that doesn't make a lot of sense to me. But yeah, I kind of agree with you.
Yeah, to me, it looks like we're gonna
90.
Yeah, 70, 76, 90, 76, 95, somewhere in there. That's what it looks like to me, providing we stay above 76, 75. If we go below
7,700 would be a nice pin for like,
yeah,
taking it on the nose, but
that would be a nice pin. That seems like, well, we still got an hour and 20 minutes. It could happen.
And it's pretty thin overnight.
I think more, I know these straddles have just been mispriced, right? And we're moving like 40, 50 handles every day.
Yeah. I've been watching it go back to what it was.
I've been saying the vol's too low, and it keeps coming in on me. But we're moving.
Yeah, I think realize has exceeded implied now, and I have a feeling that implied it's probably going to have its time to climb. But we'll see. Let me take a look at one thing here. Okay, so one thing I want to show, which is really interesting. So we can go back through the data and model things beyond what we can show you. Obviously, that's not like not saying we're hiding things from you. It's just we have access to all the raw data. So what we have in VS3D is obviously like a trading dashboard. We're working on teasing out reports that are configurable for either, some will just be part of the normal subscription, some will be part of maybe an add-on. But there's a lot of data and a lot of ability to mine it now. And so I find this really interesting. When I go through our data, obviously ignore the wings right now, but this was just taking yesterday's close and kind of simulating a path through it and trying to figure out, well, where would there be balance? Where would there be like the heaviest flow to run through potentially? And where would it settle? When I say where would there be balance? So the way that you should read this graph here is this is the charm that has to do with the resolving or expiring AM position, right? And so what that means for me as a market makers, if I have a book anywhere in this range, I'm going to have futures to buy or sell against it. And this one I already flipped to make it look like it's the hedging instead of the what it usually is the charm, the delta decay. When it's the charm and the delta decay, what you wind up getting is the opposite. Like you have to remind yourself that, okay, well, if the market maker book is getting more positive, delta needs to be selling. This is correcting for that just for the sake of the visual on the screen here. This is the area where there'd be buying implied. So there's a question in the chat that says, could you please discuss your tweet about 77.5 or 77.50 being inevitable for today due to mechanical charm? So no, I didn't say it was inevitable. I said it was probably off the table because remember, earlier in the week, I saw this is very likely, this area here. I thought we would kind of fail up here and then sell down to this area here. That was my read of the positioning before we sold off all the way through it. And I discounted, or I didn't respect how heavy the model flow was. It was the heaviest on record this year for sure. Obviously this changes, see? So when you walk through this, it's going to be different at different locations. We get here and now it's saying, oops, this has gone a little bit, this has gone a little bit far. If we keep advancing the weekend to Opex, this goes all the way to last night's close, there will be some reversion, right? So it's almost like a cushion. We sell off. Obviously there was charm associated with the entire week, not just today. This is now just today. And in fact, just the expiring position. But the expiring position says there's a range here where if we overshoot this target here at 77.18, which we obviously have, we're below there, there's buying implied all the way through here. So when I see this, the first thing I think is, it's interesting how this can be completely mechanical and can nudge the market in a way that changes perception and then creates outcomes downstream. Like a hard bounce here, for example, can completely change the path forward based on what everybody else does around it. Whereas if we just sold off a bit too far, look at how beautiful this is. We sold to virtually the level that implies zero charm. That's interesting to me. Obviously, there's no, I'm not going to say it's like perfect, but we sold off to an AM balance point last night, closed right near where selling flipped to buying. Buying started to take place overnight, and then it put us in a range where that involved probably a little bit more buying. I don't think we get all the way to 77.18 because, of course, for that charm to be there, remember this was modeled yesterday at the close, there would have to be futures sold against it at this point, and there probably are not. That's probably already decayed away. But the takeaway is that in this range here, you can usually expect it to lean a little bit bullish. It's not always the case, but in 2026, it seems like the expiration has a little bit more correlation than in 2025. And yeah, in this case, yellow, this is the required ES futures hedge to settle the expiring book as of yesterday's closing marks, right?
So explain that again. So that's...
Yeah, so basically you take the entire position. And remember, the entire position is just a fancy way of saying, imagine one option, and then it just add them all together. Imagine a market maker who owns the 7,700 call, like here. In the dashboard, you can see the position. There's market makers that own this call option.
Mm-hmm.
Now, if you own that call option, you have sold futures against it. That's already happened. That's in the past. So the impact is gone. Now, as you advance the clock, and this is the most accelerating time in that process, the call is going to expire, presumably at zero, but you have futures against it still in your book that you're short. And so you have to buy those futures back. Now, This is a pretty clean path, right? Because it's just overnight. There's not a whole lot there's no trading in this contract right now. There may be in the future if the CBOE finally gets AM listed overnight. But the point is that when you add up all the options and you take the individual quantities, the directions, and obviously isolate it to market maker holdings, you get a sum total of futures that the position needs to be bought or sold to hedge the thing at. That changes at different levels. That's the nature of the curve, right? So that's all it is. That's all it is. It's literally saying, let's advance the clock to expiration. What do we see?
Basically, go to zero. Basically, going to zero vol.
Zero vol, yeah. Zero vol is a term we used to use that was exactly that. Like imagine settling now was basically all it was.
So you're taking all what would need to be bought and sold. Okay, go back to that.
Into what?
Go back to showing that.
Oh, here?
Yeah. Okay, so interesting. So in here, there's a lot of buying, right? And then selling here. Okay, interesting. That's pretty cool.
Here's where the buying is, right?
Yeah. Or below.
Below is selling, actually.
No, below that, like.
Oh, wait, below that, yeah.
Far left. But that we're not there. Yeah.
No, that's way too far.
Yeah.
This I might have misspoke earlier. This is actually the hedge level. So this was like the inflection level, which I find super interesting sometimes when we close on test levels. I thought we trucked through it in the overnight because it felt like there was pressure against the barrier, but we actually just recovered a little bit, and then found this mechanical buying that really changed the nature of the day forward. Because otherwise, you see here, the selling would have persisted all the way until 7,600.
So it looks like, I think like 76.90.
Way more, actually.
76.90 makes sense to me.
This is cool. For today's pin.
Yeah.
Makes sense to me too, obviously.
This is a great visualization.
Let's see here. All right, so what is on deck today? Matt, you want to describe the settlement process?
Settlement process, yes.
Yeah.
We call it the SQ. That's what we refer to it as. And it's basically you just take the opening prices of all the 500 stocks. That's all the settlement process is. But it's called an SQ, a special quotation. So it can sometimes get a little bit, it's not, I mean, in the old days, it could get a little crazy. Like it would settle, the futures would be trading, say, I don't know, say the futures are trading 77.10, and you would sometimes get these settlements that were like, 20 handles from where the futures are trading. Like the cash would settle, the SQ would be 77.10, let's say, implying like the futures level of 77.30. It's not, doesn't happen as much anymore, but you still will get sometimes, you'll still sometimes get a little bit wonky settlements. I mean, there's definitely the buying and selling flows on the open contribute to some little bit strange settlements, but that's the process. It's just the opening price of all 500 stocks.
Yeah, it's not as wild as it used to be. I mean, I've seen so many.
Oh my God, it used to be nuts.
Then the minute you try to speculate, it goes against you. It's kind of a funny game. But so great question in the chat. After Opex today, would VS3D be less effective? So no, well, let's talk about that. After Opex, the way I like to think about these flows, so macro flows will take over, remember, but macro is not trading all the time. Macro flows happen, they're big, they're splashy. There are already macro flows, trades that have turned into positions that are modeled here that create things like Vanna and Charm and Gamma and Vega profiles, but they have already happened. They're not structural, they're macro discretionary. We capture those too. So when a market maker fields these, it doesn't really matter what the thesis was on behalf of the customer side. Because the customer, by and large, the way we think about hedging, they're not doing it. Obviously, they're hedging. For example, if they buy a put spread, they're hedging because they have an equity book. But the point with this is dynamic hedging. That's to track the modeled delta. And so for us, what we're trying to capture is, okay, take the universe of macro flows, take the universe of discretionary flows, now take the other side of those, the ones that don't the ones that don't cross naturally and land in the hands of somebody who's basically, their job is just to hold and hedge it. The point is that when you have all those positions, each one is kind of like a code. What's also cool about it is that these are marked to market and it's competitively liquid. And so there's no guess about the right delta as there are in a whole bunch of other derivatives that are maybe not as cleanly marked. We have a live read to confirm our delta, to confirm our path. And we know that in general, across the tens or 20s or maybe even hundreds of firms that call themselves market makers that hold these positions, they're going to be hedging continuously. So all of the macro flows are somewhat embedded in here. I'd be the first to tell you that you should respect all of the things going on. This is not everything. But to the extent that we have something that's predictable, we have a large cohort who kind of sticks to a certain methodology of hedging. And we have the position correct. And so when you put those together, you can estimate an imbalance in the flow. So like yesterday or last week, for example, when I was estimating that this would be a heavy sell week or a heavier sell week compared to those in the window or the previous expiration windows, that was just because we can know that a certain amount has to happen. It doesn't mean that we have to sell off, but knowing that a certain amount of selling has to happen can inform your path forward. It's very helpful. Great question here too. Maybe Matt, you want to tackle this. As a market maker, are you specifically focused on being delta neutral? Are you using other Greeks, correlations, etc.?
Yeah, I mean, as a market maker, you are, I would say, focused on being delta neutral. There's obviously exceptions, but from my experience at on the market making side, I was at banks for most of my career. On the market making side, I did find the hedging process to be more focused on being delta neutral than at banks, where we sort of let deltas run. We would let, at least in the banks that I worked at and the books I ran, I let deltas run a little bit more. The market makers definitely are focused on being delta neutral. I will say that market makers delta neutral is different than the typical Black-Scholes delta neutral. They have a lot of they don't hedge to Black-Scholes nearly as much as banks do. They have their own models and their own slides, and due to the position, they'll hedge straddles oftentimes on a higher put delta. Well, now they'd be hedging straddles on a higher call delta because the vol spot correlation is so positive. But based on vol spot correlations and how their position slides, they'll hedge delta neutral, but it will not be Black-Scholes delta neutral. Generally, it'll be basically they'll hedge to where, you know, they hedge to where they don't have to move the vols. Like they want to basically have a smooth slide, so they have enough minis to offset moves in the straddles or moves in the skew. So it's pretty interesting, and that's a difference between market makers and banks. Banks tend to still hedge more to Black-Scholes. Not all banks, but still more Black-Scholes. Big difference.
Yeah, basically, you're hedging everything as a sea of things. And
remember how when we were at Belvedere, like we'd have like a, you know, 56 delta on a straddle, and the banks would have like a 46, you know, or
exactly, yeah.
You know, something like it would be very different, especially on straddles and risk reversals, especially.
Yeah, when there's a lot of skew in the position, you need to model path correlation. You can't just leave it. So that's why also I encourage people, like, there was some kind of spat on Twitter recently about like, oh, GEX is not the only thing. And I'd be the first to argue that it's not the only thing. I don't know why somebody's arguing with me. We spend a tremendous amount of time in the onboarding sessions in VS3D, and also like every morning in VS Pro, and like deep diving in mentorship, talking about how all of the things are one thing. In fact, I don't even think about the options as Gamma or Vega or Vanna. It's just all one kind of unified thing, because it truly is. The distribution can move a couple of ways. It's not like you should never ignore Vanna, for example, because there's a big Gamma profile. All these Greeks can move the market. They're not super determinant. They give you a probability distribution. They give you a little bit of a bias sometimes that the market straddles can't price easily. So some other questions here, and then we'll hop and do the morning meeting soon, because we need to talk about the PM position also. But AM position, this question here, it looks like there's no clear long position in the profile. I mean, there are long positioning. There is long positioning, right? We see it right here. There's 7,700, which we're kind of coming up towards. Remember, this is Opex expiration, the AM expiration. It is one in which a lot of the flows hit the book pre-market, so it can move more. I wouldn't be surprised if we raced through here, because remember, we just crossed this C of in the money options. That actually has the effect of doing this. That puts us closer to these heavier flows, right? So we crossed through some of these, we obviously traversed a lot of this range, but there's still meaningful buying to be done, kind of implied in this area. This area being 76, 80-ish to 95. I don't think we have any chance to get to this screen here. To be clear, I don't think there's any chance to get this far, 77, 80.
Yeah, I agree.
I do think 7,700 would be like nice and neat. And then the question becomes, what happens after this? We switch to PM, right? So after this expires, there's no more influence. It's not like we have to see a big unwind of all the hedge. I want to be clear. There's rolls, there's all sorts of things. Market makers will kind of, the way I did it, we always did have some minis to trade in the AM expiration, because it was very difficult to get that perfectly clean. But in general, the whole process has been made much more smooth lately. With the CME put out contracts like basis trade at index open and close. Not sure how much the trade at open gets, but in theory, it's a way to easily offload.
It's a taco.
Like the taco. Yeah, it's right. Trade at contract open. That's what it is. Yeah. The actual
love trading the taco.
Yeah, I never remember that getting much uptake, but it sounded smart. Like it seemed like a good contract.
Or rallying a little bit more.
Bundling and new pricing. That should be up at end of month, but we'll double check.
It's going to be 76.90.
Are you calling it?
Yep, calling it. And then after expiration, wow, well, I mean, we're not going to get to 7,800 today, but there's a lot of options. There's a lot of options.
I mean, this is all. What are you looking at, Matt?
I took out I just took out the AM and switched to PM.
Okay. So yeah, let's switch over. We're gonna go to the morning meeting in a sec. So morning meeting, you guys are invited when we do these to join us in the morning meeting. It's where we go through the day ahead. All you have to do is go to the Discord. So just go to the Vol Signals Discord server. It's free today. We'll have slides in there as well. We do the call on Zoom. Obviously, you guys won't be enabled for the Zoom meeting today, but you can watch it on the Discord stage. So give us a sec and we will see you there and talk more about what we think for the day ahead. Thank you guys.